As we conclude this fraud series, let's discuss red flag indicators of fraud, including behavioral red flags, warning signs of fraud, ways to help fight fraud, and of course, resources available to your credit union. What is a red flag? A red flag is a set of circumstances that are unusual in nature or vary from the normal activity. Red flags are a signal that something is out of the ordinary and may need to be investigated further. Remember that red flags do not indicate guilt or innocence, but merely provide possible warning signs of fraud. Do not ignore a red flag. Studies of fraud cases consistently show that red flags were present, but were either not recognized or were recognized but not acted upon by anyone. Once a red flag has been noted, someone should take action to investigate the situation and determine if a fraud has been committed. Sometimes an error is just an error. Red flags should lead to some kind of appropriate action. However, sometimes an error is just an error and no fraud has occurred. You need to be able to recognize the difference and remember that responsibility for follow-up investigation of a red flag should be placed in the hands of a measured and responsible person. The following behavior changes can be red flags signaling embezzlement, including employee lifestyle changes, which might include expensive cars, jewelry, homes, or a sudden new wardrobe, significant personal debt and credit problems, behavioral changes such as drug use, excessive drinking, gambling, or fear of losing the employee's job, high employee turnover, refusal to take vacation or sick leave, lack of segregation of duties in a vulnerable area. What are the warning signs of fraud? Look out for these signs, including a small one-person shop with an inactive supervisory committee, an increased loan portfolio and no increase in delinquency, only one employee who underwrites loans and disperses funds, an inactive board not aware of credit union operations, unusual activity on dormant or closed accounts, unusual activity on employee accounts. Other warning signs of fraud include employees who have permission to perform transactions on their accounts and family member accounts, bank reconciliations that are missing or several months behind, a manager or employee who does not take vacation. What are ways to help fight fraud? First, you need to establish fraud controls. Conduct a quick assessment of your fraud controls and determine who is responsible for fraud detection and reported misconduct. Credit unions should clearly establish this oversight, which could be assigned to a senior manager, an internal auditor, or the supervisory committee. Basically, this individual or group would perform periodic reviews of employee accounts and other areas where fraud might occur. That's to detect and act early if a problem surfaces. Conduct basic fraud awareness training. Develop a formal fraud policy that's acknowledged and signed annually by each employee. This sets the tone for management as to all expectations on the conduct of employees. Screen and monitor those who have access to money. A background check on each new employee is a necessity for financial business. Employees who have access to teller drawers, the night depository, or cash deliveries all have the opportunity, so this exposure must be controlled. While background checks can be useful in screening out some bad applicants, they might not do a good job of predicting fraudulent behavior. Most fraudsters work for their employers for years before they begin to steal, so ongoing employee monitoring and an understanding of the risk factors and warning signs of fraud are much more likely to identify fraud than pre-employment screening. Periodically remind employees to be vigilant. Setting forth an expectation of awareness and the need to report any suspicious activity is critical to early detection. This whistleblower policy should be part of your employee handbook and should include a defined process of how to report any suspicious activity. Monitor your vendors. Managing and overseeing your vendors is very important, and employees also need to be vigilant and report any questionable activity. Previous history has shown that some employees, especially those who are new, might not be as knowledgeable about what constitutes fraud. For example, if a new employee receives an invoice, they may likely pay it without as much scrutiny as a more experienced employee. Training and awareness are important and help to provide early detection. Remember these red flags when reviewing all the lessons for deterring, detecting, and preventing fraud and employee dishonesty. Here is a recap of important points from each module in this series, beginning with fraud policy. Review your policies annually and revise as needed. The policies should be board approved. For a sample fraud policy, contact your bonding company, the leagues, and any other trade organizations. Surprise cash counts should be performed by an independent third party. A surprise cash count should be performed at least quarterly, every year, and unannounced. In reviewing separation of duties, remember, employees cannot perform transactions on their own or their family accounts. For loan underwriting, the loan officer should not approve and disperse loan funds. With employee and family member accounts or insider accounts, a written policy should prohibit employees from performing transactions on their accounts and accounts of family members and friends living in the same household. Insider accounts should be reviewed by the Supervisory Committee at least quarterly for unusual transactions. Vault cash. The combination to the vault should be provided to more than one person, with no one person having full access. A camera near the vault should be locked and inaccessible to employees. File maintenance reports should be reviewed frequently by an individual without transaction authority. File maintenance reports should also be reviewed for unusual and frequent transactions on individual accounts. Finally, there are many resources available for your credit union, including Supervisory Committee Guide, Federal Credit Union Act, State Credit Union League and Associations, NCUA Rules and Regulations, District Examiner, trade organizations, credit unions, bonding and insurance companies. Credit unions should approach fraud prevention with a critical eye and not take anything for granted. If you smell smoke, there is probably a fire burning somewhere. This wraps up our Askewy Fraud series. For more information, please go to this NCUA website.